Welcome to the Maybe Not So Great Books channel. You decide. This is lesson 7 of 14, why most people should just buy index funds from The Intelligent Investor, the definitive book on value investing by Benjamin Graham, commentary by Jason Zweig.
It is really good to be back for this one.
The father of value investing spent his final interview telling people to stop doing value investing.
Yeah.
Why doesn't anyone talk about that?
Because, honestly, it is probably the single most uncomfortable fact in the entire history of financial literature.
Yeah.
You have this massive industry, right? You've got seminars, newsletters, these huge asset management firms, and they are all built entirely on the foundation of Benjamin Graham.
I mean, they call him the Dean of Wall Street.
Yeah.
The father. The guru.
Exactly. They treat this book like it's scripture, and yet if you look at the very end of his life, specifically in 1976, he basically sat down and said, you know what? Never mind.
Never mind. Which is just a wild thing to say about a career that essentially defined modern Wall Street. But before we get to the end of his life, I feel like I need to push back on this immediately.
Go for it.
Because never mind, just sounds like you got old and tired. I mean, look at this book. It is dense. It's 600, maybe 700 pages long.
Oh yeah, it's a brick.
It has tables. It has complex formulas, criteria for current ratios, tangible book value. When you pick this up, you are definitely not picking it up because you want to be told to do nothing.
No, of course not.
You are picking it up because you want the secret sauce.
Right.
You want to beat the market. You want to win.
You buy The Intelligent Investor because you want to be what he calls an enterprising investor. That is the dream.
Right, the person who beats the odds.
You want to be the one who finds that diamond in the rough. You want to find the next NVIDIA or, the next Zweig before anyone else does. That is the promise the book seems to make. Or at least that is the promise the financial industry sells you on.
Yeah, the industry definitely pushes that angle.
But the lesson we are covering in this deep dive lesson 7 is essentially the anti-lesson. It's the part that says the best way to win is to actually stop playing the game the way you think it's played.
Okay, but isn't that a bit defeatist? I mean, to you listening right now, it feels a bit like telling a kid who desperately wants to be an NBA player, hey, statistically, you should probably just be an accountant.
That's a rough conversation.
Right. Like, it might be statistically true, but it is a massive buzzkill.
It definitely feels like a buzzkill until you actually look at the scoreboard, because in investing, the accountant might actually retire with significantly more money than the guy playing pickup basketball at the YMCA who thinks he's LeBron James.
Fair point.
But to really understand why this massive shift happened, we have to go back to the scene of the crime.
The 1976 repudiation.
Yes.
Set the stage for us, because this wasn't just some casual conversation he had over coffee.
Right at all. It is 1976. Benjamin Graham is in his 80s at this point. He is essentially retired, living his life in the south of France.
Sounds nice.
It does. And he has spent his entire life in the trenches of Wall Street. He survived the Great Depression. He taught Warren Buffett. He is the guy. And he sits down for an interview with the Financial Analyst's Journal.
And just to clarify for everyone listening, the Financial Analyst Journal is not like People magazine.
No. This is a hardcore trade publication for the pros. The subscribers are people who have CFA stamped after their names.
The heavy hitters.
Exactly. These are the people who make their actual living analyzing stocks using the very methods that Graham invented. So they are reading this interview expecting the master to give them one last secret weapon, one last formula to navigate the stagflation of the 1970s.
They want the cheat code.
And instead, Graham drops an absolute bomb on them. I'm going to read this quote slowly because every single word of this matters.
Let's hear it.
He says, "I am no longer an advocate of elaborate techniques of security analysis in order to find superior value opportunities."
Wow. No longer an advocate. That is, I mean, imagine you were a security analyst in 1976.
Right.
You have spent your entire adult career memorizing Graham's formulas. You are out there digging for net nets. You're calculating liquidation values late into the night. And the literal guy who invented your job tells you, yeah, I don't advocate for this anymore.
It actually gets worse.
Oh, man.
He continues and says, "I doubt whether in most cases such expensive efforts will generate sufficiently superior selections to justify their cost."
Justify their cost. That is really the key phrase there, isn't it?
It is the whole ballgame.
Because he is not saying the techniques don't work in a vacuum. He's saying the squeeze just isn't worth the juice anymore.
Exactly. He is doing a cold, hard cost-benefit analysis on his own life's work. And then he finishes with, to that very limited extent, I'm on the side of the efficient market school of thought, now generally accepted by the professors.
The professors. Graham was the ultimate practitioner. He was the guy who notoriously said the professors were way too theoretical, just living up in their ivory towers. And now, on his deathbed essentially, he is siding with the academics. That must have felt like a massive betrayal to his followers.
It was a huge pivot, but think about what he is actually saying underneath that. He is saying that the market itself has fundamentally changed. When he started out back in 1914 or even 1934, the market was the Wild West.
Completely unregulated, mostly.
Right. But by 1976, the market had become much more professional. It was more crowded. He is admitting that the informational edge he used to rely on was simply gone.
So my question is, why isn't this interview printed in giant bold letters on page 1 of the book? Why do we have to dig through financial history lessons just to find this?
Wow.
I mean, if I buy a book on how to fix cars and the author later said, actually, modern cars are way too complex now, just take it to the shop, that warning should be on the cover.
It should, but you have to think about the incentives involved.
Follow the money.
Always. The publishing industry, the massive financial advice industry, they have a huge financial incentive to quietly bury that 1976 conclusion. If everyone listening right now just bought a simple index fund, nobody buys the thick book. Nobody pays for the expensive weekend seminar.
And nobody pays the 2% management fee to the mutual fund manager.
Exactly.
It is honestly like a doctor writing the definitive textbook on complex heart surgery, selling millions of copies to medical students, and then on his deathbed saying, actually, guys, just tell people to eat an apple a day and they'll never even need the surgery.
That is a brilliant analogy. And the surgeons out there are still aggressively selling the surgery because, well, that is how they pay their mortgages.
Right.
But Graham, at the very end, he didn't have a mortgage to pay anymore. He had absolutely nothing left to prove to anyone. He was just telling the truth as he saw it in that moment.
But I want to play devil's advocate here for a second.
Okay.
Graham was old. Maybe he had just lost his touch. Or maybe he just didn't want to do the grueling work anymore. Just because an 80-year-old man gave up doesn't mean that I should give up.
That is a totally fair pushback. And honestly, if it were just his late-in-life opinion, we could easily dismiss it as the ramblings of a tired man. But Graham was fundamentally a numbers guy. He didn't just wake up one morning and decide to throw in the towel.
You brought the receipts?
He did the math. Which brings us right to the core concept of this deep dive. And this concept is actually embedded in the book itself, in Chapter 9. It's what we call the math of mediocrity.
Chapter 9 is titled Investing in Investment Funds, right?
Correct. So even way before that 1976 interview, Graham was already looking hard at the data. He analyzes the historical performance of mutual funds. Now, keep in mind, in Graham's day, mutual funds were the undisputed experts.
Right. These are the ultimate enterprising investors doing it full time.
These are the pros, the smartest guys in the room with the best resources.
And what did he actually find when he ran the numbers?
He found that, on average, they do not beat the market. In fact, over long periods, they tend to do slightly worse than the market average.
Okay, I hear people say that all the time.
Huh.
Active managers don't beat the market. But I really want to understand why. If they are so smart, if they have all these supercomputers and armies of analysts from Ivy League schools, why can't they win?
Because of the zero-sum game. And this isn't just some vague economic theory, it is a mathematical certainty. We really need to spend a minute unpacking this because this is the specific concept that usually breaks most people's brains.
All right, break my brain. Explain it to me like I've never heard it.
Okay, let's use an analogy. Imagine a poker table.
Okay.
There are 4 of us sitting at this table. You, me, and 2 of our listeners. We each take out our wallets and put exactly $100 on the table. So the total market at our little table is $400.
Got it, $400 pot.
We play poker for an hour. We're trading chips back and forth, bluffing, winning hands, losing hands. At the end of the hour, we stop and count the chips. How much total money is sitting on that table?
Well, it's still $400. Unless someone somehow ate a chip.
Right. It is exactly $400. If I had a great night and made $50, then you or someone else at the table must have lost $50.
Because the money has to come from somewhere.
Exactly. Before costs, poker is a pure zero-sum game. The group as a whole cannot possibly win more than the group put in. The stock market works the exact same way. The market return you see on the news is just the weighted average of what all investors did that day.
So if the market goes up 10%, the average dollar invested just went up 10%. Okay, so far so good.
Yeah.
If the market is up 10% and I am exactly average investor, my portfolio is up 10%. That doesn't sound brain-breaking.
But here's the kicker. Investing in the real world is not a zero-sum game. It is a negative-sum game.
Negative sum? Why?
Because of the croupier, the house. Back in our poker game, imagine the casino dealer takes a $5 rake out of the pot every single time we play a hand. Let's say we play 20 hands in that hour. That is $100 permanently removed from the table.
So now there's only $300 left on the table for the four of us to split.
Exactly. Even if we are all brilliant, world-class poker players, the average result for our group is now a massive loss of 25%. In the stock market, the croupier is the friction of the industry.
The fees.
Yes, it's management fees, it's trading commissions, it's the bid-ask spread when you buy and sell. And the biggest silent killer of all, taxes.
So if the overall market goes up 10% in a year,
the gross return for all investors combined is 10%, but then the financial industry steps in and takes its 1 or 2% cut right off the top. So the net return for those investors is really only 8 or 9%.
And what about the index fund in this scenario?
The index fund just sits there at the table and says, you know what? I'm not going to play any active hands. I am just going to hold my chips. It has almost zero fees. It doesn't trade, so it doesn't generate tax bills. So if the market is up 10%, the index fund is up maybe 9.95%.
Wow. So mathematically, the average active investor must underperform the index fund, because the active investor is constantly paying for the privilege of trying to beat the other active investors.
Precisely. It is mathematically impossible for the average active investor to beat the passive market return after fees are deducted. It has absolutely nothing to do with how smart they are. It is just basic arithmetic.
That is honestly kind of depressing. It's like suddenly realizing the casino really does always win.
The casino always wins, unless, of course, you own the casino, or unless you completely refuse to play the high-stakes games and just quietly bet on the house. That is exactly what indexing is.
So Graham saw this happening. He looked at the data and realized that the enterprising effort people were putting in wasn't adding nearly enough value to cover the enterprising cost.
Right.
And this is where Jason Zweig's modern commentary on the book becomes so crucial, because Benjamin Graham obviously didn't have Vanguard index funds to buy back in 1949.
No, the very first retail index fund, the Vanguard 500, didn't even launch until 1976, which, ironically enough, is the exact same year Graham gave that interview and then passed away.
The timing is wild.
It really is. But Zweig argues in his commentary that the framework Graham built for the defensive investor naturally and inevitably evolves into the modern index fund.
Let's trace that evolution for the listener, because in 1949, Graham gives very specific advice on how to be a defensive investor. He wasn't telling people to buy an ETF. What was his actual advice back then?
In 1949, his advice was to buy a widely diversified list of prominent blue-chip stocks. He basically told you to build your own index manually.
Right.
You'd go out and buy shares in 30 massive companies, Dow Chemical, General Electric, AT&T, and you just hold them. You don't trade them. You are essentially doing the manual labor of replicating the Dow Jones Industrial Average.
Okay, so that is step one in the evolution. Manual indexing. It's clunky, it takes some capital to set up, but it works.
Then jump forward to 1976 in that final interview. He is now advising people to just use mechanical screens. He says, look, just buy a basket of stocks with a PE ratio under a certain number or a dividend yield over a certain percentage. Don't even bother analyzing the underlying business. Just blindly trust the statistical screen.
Taking the human emotion out of it.
Exactly. That's a huge step closer to total automation.
And then Jason Zweig comes in around 2003 with his updated commentary.
And Zweig says the only logical conclusion of Graham's defensive philosophy today is simply to buy the Vanguard 500 or a total stock market index fund.
Because it hits all the criteria.
It fulfills every single requirement Graham ever had for the defensive investor. It is perfectly diversified, it is incredibly low maintenance, it minimizes the risk of making a significant behavioral error, and most importantly, it absolutely guarantees that you will get the market return.
Which, as we just established with the poker analogy, is better than what most highly paid professionals get.
Exactly. Zweig uses this phenomenal concept in his commentary called the loser's game. It originally comes from a famous paper by Dr. Simon Ramo, who was a scientist, and it was later popularized in finance by Charles Ellis.
The loser's game. I love that title.
Sure.
What does it actually mean in this context?
So Rama was a brilliant scientist, but he just absolutely loved playing tennis. And being a scientist, he decided to statistically analyze professional tennis matches and compare them to amateur tennis matches.
Okay.
He found that in professional tennis, we're talking Wimbledon, Federer, Nadal points are won. These guys hit the ball with incredible power, crazy spin, perfect precision. They hit aces, they hit passing shots right down the line.
Yeah.
To win a point at that level, they have to proactively do something amazing.
Right. If you watch the SportsCenter highlights, it is all just incredible winners.
But then you looked at amateur tennis, like me and you playing at the local public park on a Sunday afternoon.
Which is usually physically painful to watch. Yeah.
It is hideous. And he found that in amateur tennis, points are not won, they are lost.
Because we suck.
Because we hit the ball straight into the net. We double fault on our serves. We hit it completely over the fence into the parking lot.
Yeah, that sounds like my game.
The opponent doesn't actually have to defeat us with skill. They literally just have to wait patiently for us to defeat ourselves.
So the winning strategy for the amateur is simply just get the ball over the net, keep it in bounds, don't try to be a hero.
Exactly. And here is the profound takeaway. Investing is amateur tennis for almost everyone. It is not about hitting the amazing highlight reel winner stock pick. It is entirely about not double faulting.
It's about not hitting the bell into the net.
Right. Indexing is the ultimate defense against unforced errors. You don't pay high fees, which is an error. You don't trade constantly and rack up huge tax bills, which is an error. You don't put half your net worth in a trendy company that suddenly goes bankrupt, which is a massive error. You just keep gently dinking the ball back over the net. You just stay in the game.
That is such a powerful image for you to keep in mind. We are all out here trying to hit these leaping overhead smashes, and we are really just whacking ourselves in the face with the racket.
Exactly.
Graham is basically saying, look, just tap it over the net, and you will eventually beat 80% of the people out there.
Yes. And that is exactly why it works. Because the heroes are mostly just bleeding money trying to hit the line.
Okay, I am totally with you on the math, and I love the tennis analogy.
Yes.
But there's a massive glaring contradiction in this whole story, and his name is Warren Buffett.
The Oracle of Omaha himself.
Right, Graham's absolute best student.
Yeah.
The man who literally wrote the preface to the version of the book we are reading. If Graham says, give up and just buy an index, why does Buffett explicitly say, keep trying?
That's a great question.
Or at least, why did Buffett spend his entire life trying? I mean, if the market is so incredibly efficient, how does a guy become worth over $100 billion just by picking stocks?
This is the exact tension that lies at the very heart of value investing. It is the classic teacher versus the student dynamic. And to really understand it, we have to look at what is probably one of the most famous essays in all of financial history, which is actually included as Appendix 1 in the back of this book. It's called The Saper Investors of Graham and Doddsville.
I really love this story. Set the scene for this one. Because this wasn't just an essay he published in a magazine. This was originally a live speech, right?
It was. The year is 1984. We are at Columbia University. This was an event celebrating the 50th anniversary of the publication of Security Analysis, which was Graham's first textbook. The room is absolutely packed.
High tension in the room.
Very high, because you have all the efficient market professors sitting on one side, the academics, who loudly proclaim that stock picking is mathematically impossible. And then you have Warren Buffett walking up onto the stage.
And the professors are basically looking at him saying, Warren, you are just incredibly lucky. You're a statistical anomaly, nothing more.
Right. They love to use the specific coin flipping analogy, the academic said. Listen, if you get 225 million Americans to all stand up and flip a coin every single morning, simply by the sheer laws of probability, someone out of that massive group is going to guess right 20 days in a row.
It's basically the infinite monkey theorem. If you have enough monkeys just banging away on typewriters, eventually one of them is going to type out Hamlet.
Exactly.
But it doesn't mean the monkey is a literary genius. It just means, yeah, a lot of monkeys.
Exactly. So they are essentially telling Buffett to his face, you are just the lucky monkey who wrote Hamlet. You're the guy who flipped heads 20 times in a row. Congratulations on your incredible luck, but don't pretend it's a repeatable skill.
That is pretty insulting to tell the richest investor in the world. How did he actually respond to that in the speech?
He responds with this beautiful, classic, folksy metaphor that only he could deliver. He stands up there and says, okay, I agree with your math. If 225 million people flip coins, sure, you'll end up with a couple hundred winners who flip 20 heads in a row. But But what if you found out that 40 of those consistent winners all came from the exact same zoo in Omaha?
The same zoo.
He is saying, what if you dug into the data and realized they all came from the exact same intellectual village? What if they all studied under the exact same teacher, Ben Graham? What if they all read the exact same book and used the exact same metrics?
That changes the math entirely.
Right. If you find a huge statistical concentration of winners who all consistently use the exact same technique, you can no longer call it random luck. It is a specific, demonstrable intellectual lineage, and he calls this metaphorical village Graham and Doddsville.
And he doesn't just leave it as a metaphor. He brings the receipts. He starts listing the other actual inhabitants of this village.
Yes, and this is a crucial part of the speech because these aren't all famous billionaires like Buffett who own massive holding companies. He talks about a guy named Walter Schloss.
For the listener who hasn't heard of him, who was Walter Schloss?
Walter Schloss is basically the complete antithesis of the slick, modern Wall Street guy. He didn't even go to college. He worked as a runner for Ben Graham back in the day. And when he eventually started his own fund, he worked out of a single tiny room.
No fancy corner office.
No computer, no ticker tape machine. He didn't even talk to management. He just sat there and read the boring financial manuals all day long.
He was a digger, just digging through the dirt.
He was an absolute scavenger. He just looked for boring, ugly companies that were trading for less than their working capital. And he did this exact same routine for 45 years. And he absolutely crushed the market.
Incredible.
Buffett uses him as the prime example because Schloss didn't have any inside information. He didn't have speed or technology. He just had the Graham philosophy and an iron stomach.
So Buffett is standing on that stage in 1984 saying, look at Walter Schloss. Look at Tom now. Look at Bill Ruane. We all learn from Graham, we all apply the same rules, and we all consistently beat the market. Therefore, the market is fundamentally beatable.
Exactly. He is fiercely defending his teacher's legacy against the academics who are trying to erase it.
But wait, this brings us right back to the central contradiction of this deep dive. Graham in 1976 essentially said, stop, it doesn't work anymore. Buffett in 1984 said, look at us, we are winning. Who is actually right?
The secret is they are both right. And understanding exactly why they are both right is the whole key to this entire topic.
Walk me through that. How can they both be right? One says red light, one says green light.
Well, Buffett definitively proved that the method can work. He proved it is theoretically possible to be an enterprising investor and win over the long term. But, and this is the deep dive nuance here, Buffett and his peers were extreme outliers in terms of their psychological temperament and their discipline.
They were the Michael Jordans of investing.
Correct. And just because Michael Jordan can jump from the free throw line and dunk a basketball doesn't mean that you can.
Definitely not.
Graham was writing this book for the general public. He was writing for the local dentist, the lawyer, the school teacher. For those everyday people, Graham knew deep down that trying to emulate Walter Schloss was a guaranteed recipe for disaster.
Right, because Walter Schloss was literally willing to sit in a closet and read dry balance sheets for 8 hours a day. I am not willing to do that. Most of you listening are not willing to do that.
Exactly. And even beyond temperament, Walter Schloss started his career in a completely different era, which really brings us to the why this matters today part of the conversation, because we are not in 1976 anymore. And we are definitely not in 1984. We are in 2026.
So have the Buffett path become harder? Or is that path still open if you were actually willing to sit in the closet and do the reading?
It has become exponentially harder. We really have to talk about what's known as the vanishing edge.
What edge has vanished?
Think about what Walter Schloss or Ben Graham is actually doing in the 1940s and 50s. If Graham wanted to research a railroad company, he would literally take a physical train down to Washington, D.C., go into the Interstate Commerce Commission building, and request physical paper filings.
He was dusting off papers in a basement that literally nobody else had looked at in months.
Right. There was no internet, there were no searchable databases. Information traveled at the physical speed of the Postal Service mail. So if Graham found a company where the cash sitting in their bank account was worth more than the entire stock price, he could quietly buy it. And it might take 6 months for the rest of the market to even figure it out. He had a massive informational advantage.
And contrast that with today.
Today, a publicly traded company releases its 10K financial filing electronically at exactly 4:000 p.m. By 4:000 0.000000 and 1 second PM, literally 1 single second later, what happens?
AI happens.
Exactly. A highly advanced AI algorithm run by a multi-billion-dollar hedge fund in New York ingests that entire document, parses all the data, compares it to 20 years of historical norms, checks it against real-time competitor data, and executes a multi-million-dollar trade.
Before a human being has even had time to read the title page of the document.
Before you have even hit refresh on your browser, the informational edge is just gone, completely gone. You cannot outread a computer. You definitely cannot outcalculate a computer.
So those nets who used to buy those companies trading for less than their literal cash value, do they even exist at all anymore?
Almost never. And when they do pop up on a screen today, they are almost always outright frauds or weird overseas reverse mergers or something with a massive, hairy legal problem that the AI algorithm has already spotted and decided to avoid.
We actually have hard data on this vanishing edge, right? The value premium.
Yes. The Fama French data. Eugene Fama and Kenneth French are the famous financial professors who actually measured this over time. They looked at exactly how much better value stocks, which are the cheap stocks Graham loved, did compared to flashy growth stocks.
Give me the numbers on that.
So from 1963 to 1991, the value premium was huge. It was about 4.3% per year, meaning if you just bought the cheapest stocks, you beat the overall market by 4.3% annually. That is the kind of compounding advantage that creates billionaires. That is the golden era of Buffett and Schloss.
Okay, 4.3%. And what about since 1991?
From 1991 all the way to 2019, that premium completely collapsed down to 0.6% per year.
Ouch. That is basically zero.
It is statistical noise at that point. And as we've seen in the 2020s, with the absolute dominance of mega-cap tech, value investing has often severely underperformed. In finance, this is called the arbitrage effect, or, more broadly, the paradox of skill.
The paradox of skill. I want to hear about this.
It's a fascinating concept, popularized by Michael Mauboussin. He says that in any competitive game, as all the players collectively get more skillful, the role of luck actually becomes more important in determining the winner.
Wait, that sounds totally backwards. If everyone has a ton of skill, shouldn't pure skill matter more than ever?
You'd think so, but no. Think about the Olympic 100-meter dash.
Okay.
The absolute difference between the guy who wins the gold medal and the guy who finishes dead last in the final is like a tenth of a second. They are all incredibly, unbelievably fast. The skill gap between them is almost non-existent, so the difference between gold and last place usually comes down to a tiny gust of wind, or maybe someone got a slightly better night's sleep, or a microscopic difference in reaction time at the starting gun. Luck decides the ultimate winner specifically because the variance in skill is so low.
Ah, I see. So back in 1950, Graham was essentially running a race against people who didn't even know how to tie their shoes. He could easily win on pure skill and effort. But today, every single person in the market is Usain Bolt.
Exactly. Everyone has a Bloomberg terminal, everyone has a CFA charter, everyone has AI.
The average investor today is just so much smarter, better equipped, and faster than ever before, which makes beating those other investors harder than it has ever been in human history.
Exactly. So if the informational edge is completely gone and the competition is impossibly fierce, we have to ask, what does a successful defensive investor actually look like in 2026?
In 2026, a defensive investor definitely doesn't try to manually pick 30 stocks.
Yeah.
They just buy the whole haystack. They buy a broad, low-cost ETF.
And the fascinating thing is, even Warren Buffett, the guy who stood on that stage in 1984 and fiercely argued for active stock picking, even he has seemingly accepted this new reality for regular people, hasn't he?
Oh, this is the Buffett pivot, and it is so vital to understand. Warren Buffett has very specific instructions written into his will for exactly how his wife's inheritance should be invested after he passes away. Do you know what those instructions are?
I do. And it is honestly shocking if you don't know the context. He didn't say, hey, give all the money to my hand-picked guys at Berkshire Hathaway to manage. He didn't even say, just buy Berkshire stock and hold it forever.
No. He explicitly wrote, put 10% of the cash in short-term government bonds and put the other 90% in a very low-cost S&P 500 index fund, specifically Vanguard.
That is the ultimate endorsement of Graham's final realization. The absolute greatest stock picker in the history of capitalism, for the person he presumably cares about protecting the most, says, just index.
He fundamentally agrees with Graham's deathbed conclusion. For regular people, and regular people includes his own wife, and it certainly includes you and me, the active stock picking game is simply no longer a game worth playing.
Okay, so this all sounds great. It sounds incredibly easy. Just buy the S&P 500 index, go sit on the beach, and slowly get rich over 30 years.
Sign me up.
But we are doing a deep dive here, which means we have to look critically at the limitations of this advice. Because if it were truly that easy, absolutely everyone would be rich and perfectly happy. What is the catch here?
The catch is entirely psychological, and it is perfectly captured in one specific word that Graham uses over and over: satisfactory.
Satisfactory. It sounds mediocre. It sounds like bringing home a solid C on your report card.
But in the math of investing, achieving a satisfactory market return is actually incredible. Over time, it means doubling your money every 7 to 10 years. But psychologically, it feels like you are settling. When you deliberately choose to buy an index fund, you are guaranteeing to yourself that you will never, ever beat the market. You are effectively signing a binding contract that says, I accept that I will be perfectly average.
And that hits the human ego really hard, especially for type A, enterprising kind of people. We all desperately want to be exceptional. We want to be the genius who bought Amazon back in 1997. We want to be the visionary who bought Bitcoin when it was at $100.
Exactly. By indexing, you are explicitly capping your upside. You will never have that thrilling story at a cocktail party about how you made 1,000% return on some obscure biotech startup. You are officially opting out of the lottery.
It is the Lake Wobegon effect, right? That old radio show joke where all the women are strong, all the men are good looking, and all the children are above average.
Yes, surveys show this all the time. 80% of drivers firmly believe they are better than the average driver. 90% of college professors think they are better teachers than their average peer. And 99% of investors think they have what it takes to beat the average market return. Indexing requires you to look yourself in the mirror and say, in this specific arena, I am completely average. And that is a surprisingly hard thing for a human being to accept.
There is also a much bigger, almost philosophical problem with this too, right? If every single person accepts they are average, if absolutely everyone just indexes, doesn't the entire stock market just break?
This is what economists call the efficient market paradox. It is the ultimate limitation of this theory on a broad societal level.
Walk me through this paradox. Let's say every single person listening to this right now goes out and buys the S&P 500 tomorrow. Literally no more active stock picking.
Then who is actually setting the prices of the stocks?
Nobody.
Right. If Apple, say, releases a terrible new iPhone and sales completely tank, nobody sells the stock because everyone is just blindly buying the index every 2 weeks in their 401k. The price doesn't go down to reflect the bad news. The market completely loses its efficiency. Capital just gets blindly allocated to bad companies simply because they are already big.
It would be a total disaster. You'd have a zombie economy.
Exactly. The market is only efficient because active investors, the aggressive hedge funds, the Buffetts of the world are out there doing the brutal hard work of trying to exploit those inefficiencies. They are the sharks swimming around cleaning up the ocean. If all the sharks suddenly become vegetarians, if everyone decides to become a passive, defensive investor, the entire ecosystem eventually collapses.
So indexers are essentially free riders. The passive index fund investor is just drafting off the incredibly hard work and research of the active investors.
Yes. We actually need some people out there to be delusional, enterprising investors. We need active managers to keep the market prices honest. But the profound irony is, for the whole machine to work, most of those active people have to try to beat it and fail, just so that the passive indexers can sit back and quietly succeed.
It is almost parasitic when you think about it. But hey, I would much rather be the parasite quietly getting rich than the host constantly getting eaten.
Graham actually admitted this tension in the book. He said there is a satisfactory path, the defensive one, and an enterprising path. The ultimate trap, and this is the biggest limitation for listeners to watch out for, is that most people genuinely think they are enterprising, but they actually act like speculators.
They think they are doing the hard work, but they are really just gambling.
Right. They read a couple of blog articles, they watch 3 YouTube videos on technical analysis, and they honestly think they are rigorously analyzing stocks. Graham makes it very clear. If you want to be enterprising, it is a full-time, grueling job. It is a real business. If you treat it like a casual weekend hobby, you will get absolutely crushed.
So let's pivot to the larger debate here, because we have this massive 700-page book. We have the 1976 interview where the author basically says, stop doing this. We have the modern 2026 world where AI algorithms run the show. The big question is the intelligent investor completely obsolete now? Is it just a historical museum piece?
This is a really fierce debate in the finance community. And I think there are two very strong sides to it.
Let's hear side A first. Side A says, throw the book in the trash.
Side A says, just look at the specific formulas. Graham explicitly says to buy stocks with a PE ratio under 15. Well, in the tech-driven market of the 2020s, good luck finding any high-quality growing company with a PE under 15. He says to buy companies trading below their tangible book value. But modern tech companies barely have physical book value. Microsoft's value is in its intellectual property and network effects, not in physical factories.
So if you actually follow his strict instructions literally today, you might actually lose a ton of money. You'll end up buying what they call value traps, dying retail chains that look cheap on paper but are actually slowly going to zero.
Exactly. Side A powerfully argues that the manual part of the book, the specific step-by-step instructions on how to screen and pick stocks, is completely broken for the modern era.
Okay, that is a very persuasive argument. What does Side B say?
Side B says, yes, the specific mathematical formulas are dead, but the underlying psychology is immortal.
This is Chapter 8 and Chapter 20.
Yes. The concept of Mr. Market from Chapter 8 and the concept of margin of safety from Chapter 20. Side B argues that human nature has not changed one bit since 1949. We still get incredibly greedy at the market tops, and we still get irrationally fearful at the bottoms. We still desperately chase fads. We still panic and sell everything when the news headlines look bad.
So you need to read the book not to learn how to pick individual stocks, but to learn how to behave correctly while you own your investments.
Precisely. Think about the index fund investor we've been praising. You buy the S&P 500, it sounds so easy in theory. But what actually happens when the S&P 500 suddenly drops 30% in a month?
Like it did in early 2020. Or back in 2008.
Yes. If you haven't read Graham, if you don't truly understand the metaphor of Mr. Market, if you don't understand that the market is essentially a manic depressive business partner who offers you wildly different prices every day based entirely on his mood, not on underlying value, you will panic.
Yeah.
You will sell your perfectly good index fund right at the absolute bottom.
So the ultimate irony here is you start reading this massive book to learn how to pick stocks. And if you read it correctly and internalize it, you actually learn why you shouldn't pick stocks. And D, you gain the emotional discipline required to just stick with your boring index fund.
That is the ultimate synthesis. The book today is really a tool for behavioral modification, not for financial calculation. It is basically a deep therapy session for your wallet.
I love that. A therapy session for your wallet. Because it really isn't about outsmarting the market. It's entirely about outsmarting yourself.
The investor's chief problem, and even his worst enemy, is likely to be himself. Graham wrote that line over 70 years ago, and it is arguably more true today than it has ever been.
Absolutely. So we have covered the history, the math, the stories, the limitations. Now we really need to land the plane here. It's Monday morning. I'm inspired by this deep dive. I want to be a modern Graham disciple in 2026. What do I actually go out and do?
The very first action step is to honestly define yourself. You need to look in the mirror and ask, are you genuinely willing to treat investing as a full-time, intense business? Are you willing to read dry 10K filings, manually analyze balance sheets, and try to compete against AI algorithms and massive hedge funds for 60 hours a week?
For 99.9% of the people listening to this, the honest answer is no. I have a demanding day job, I have kids, I have a life. I want to actually enjoy my weekends, not read corporate annual reports.
Exactly. Then you have to stop trying to be an enterprising investor. Stop trying to manually pick individual tech stocks. Stop listening to those hot stock tips from your brother-in-law at Thanksgiving.
And what do I do instead?
You execute the defensive pivot. You convert your messy, scattered, stock-picking portfolio into a broad, low-cost market index fund. The total stock market index or the S&P 500.
You just buy the whole market.
You buy the market. You completely automate your monthly contribution so you don't even have to think about it. And this is really the hardest part. You completely accept satisfactory results. You have to emotionally embrace the idea that you will get the exact market average return, no more and no less.
Graham actually had a really famous quote about this very idea in Chapter 20, didn't he?
He did, and it is honestly the perfect closing thought for this lesson. He wrote, "To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks."
Harder than it looks. That is the eternal trap that catches so many smart people.
And easier than most people realize is the incredible gift he left us. But before we wrap up, I want to leave you with one final, slightly provocative thought to just mull over this week.
Let's hear it.
We talk about how indexers are basically free riders on the hard work of active investors. Well, as we move deeper into the 2020s and beyond, and AI completely takes over all the active trading, Human beings won't be setting the prices anymore. Machines will. So if you just buy a passive index fund 20 years from now, you won't be free riding on the hard work of Wall Street analysts anymore. You will literally just be making a pure, uninterrupted bet on human ingenuity while the machines just trade the pieces around among themselves. By actively doing nothing, you might actually be making the most profoundly optimistic bet possible on the future of humanity.
Wow, doing nothing as the ultimate bet on human progress. That is a fascinating way to frame it.
Choose the easy, satisfactory path. Don't make it harder than it looks.
It feels like permission to just let go of a whole lot of unnecessary stress.
That was lesson 7 to 14 on The Intelligent Investor, the definitive book on value investing. Subscribe for the full series. If you haven't seen our debate overview of the whole book, check that out, link in the description. Thanks for being here. See you next time.